share buyback, also known as a share repurchase, is a corporate action of a company buying back its own outstanding shares from its existing shareholders at a premium to the prevailing market price. Take a company X. If the current market price of the company in the market is about 100 rupees, the company might come up with a buyback of a price of 120 rupees. So there's a premium of 20 rupees there. But why do companies do this? Why do companies come up with buyback offers? Buyback is just another form of rewarding shareholders in addition to paying dividend by returning surplus cash generated by the company. It is also beneficial for the existing shareholders because the number of shares come down after the buyback, and it improves the key return ratios for the existing shareholders. And the key return ratios are the earnings per share or the return on net worth and the return on assets for the continuing shareholders. Sometimes corporates may also go for buyback to support the market price of the share in the volatile market. As per Deloitte's report on buyback of shares in 2020, Dalmia Bharat, a sugar manufacturer, went for 500 crore buyback to provide support to its share price. Now, what does it signify to the investors? For an investor, a buyback usually signals the confidence of the management in the underlying fundamentals of the business. Now, if the shareholder wants to tender the shares in the buyback, and if they are trying to decide on whether it's a right choice or not, there are a couple of factors that they should consider. If you as a shareholder think the share is overvalued at the buyback price, considering the future prospects of the company, you can decide to tender the shares. But if you're a long-term investor and believe in the long-term return generating potential of the company, you can decide not to tender the shares, as buybacks are also EPS, earnings per share accretive in the long run. Now, there could be some investors who may want to take advantage of the difference between the buyback price and the prevailing market price. So they try to buy the shares at the market price and tender shares in the buyback, which is at premium. Now, they should also consider that all the shares that are tendered in the buyback may not be accepted by the company. So the key point that comes into picture here is the acceptance ratio. Now, acceptance ratio is the ratio that indicates the number of shares accepted in a buyback offer by the company as compared to the total number of shares tendered. For instance, if you tender 100 shares and the acceptance ratio is only 60%, only 60 shares out of the total tender shares will be bought back by the company. So if you're an investor who is buying the shares in the market just to tender in the buyback, you should remember that a few of your shares that will be tendered in the buyback will not be accepted by the company, and you should be ready to hold the shares or sell the shares at the market price after the buyback. And one of the key benefits of tendering the shares in the buyback is also the taxation part. Buybacks are usually tax efficient for investors. The capital gains earned on sale of the shares via buyback are exempt from tax. And because it is exempt, the gains are exempt, any loss incurred from the buyback is also not available for set off or carry forward purposes for the investor.